Hi, my name is Christoph van Tonder. I'm a chartered accountant here in Luxembourg, and today I'm going to talk to you guys about exit valuations and why it is important to know what the consequences are using each one of them and why we are using each one of them. So without delay, I'm going to start showing you. So there are three basic exit valuations you could use when selling assets, taking them out of your portfolio. So you will evaluate them at last in, first out, first in, first out, and weighted average cost. So the WAP. So where do people make the mistake? Well, not all assets are the same, and not identical assets are the same in the sense that they have the same purpose. And these are the things that you should consider when you are deciding on how to evaluate your exit costs. This is something you need to discuss with your accountant beforehand. It's very easy to decide at the beginning, but you might end up not having the right figures in your accounts at the end. So this is the purpose of this video, to give you some insight on why you should choose which valuation method on the exit. So what I see most here in Luxembourg is that the tendency is just to use the WAP, the weighted average price. However, this doesn't mean it's the correct or the best method to evaluate your exit price, as it is normal that many of the accountants or accounting firms use the WAP because it's also the easiest to set up in their accounting systems. However, deciding on whether to use FIFO, LIFO or WAP is a very important and integral part in deciding on your accounting policies. So why is it important? So first of all, you need to understand what the purposes are of your different assets, and then you can decide on how to evaluate it. So it depends. I'm going to give you a quick example to think about. So let's take cookies. It's quite different if you're a supermarket selling cookies, buying the same standard cookies, selling cookies which are selling themselves, than if you're a cookie broker. Cookie brokers need to make their profit on getting the best price for each of their cookies and selling them at the best price. So these are two identical assets, different purposes, different business models. So these are the things you're going to take into consideration. Now, sometimes I get the following comment that choosing your valuation method is not really that important, because once you've sold off all your assets, then it's already integrated into your P&L, and so it's nothing more or less than profit shifting on your account. Sorry, I have to strongly disagree with that. That's not the purpose. So what are the purpose of financial statements? It's a measuring tool of the performance of the management in general as well. So you could really use this in your financial statements to decide and measure the performance of your board. It's an integral tool, and this is why it is important to decide correctly on which method you're going to use. Next, also, I'm going to just show you guys a typical investment in using a J-curve of a venture capital fund. So, and also illustrate how and why it makes a difference on using LIFO, FIFO or weighted average price in measuring your profits at the exit. So first, we'll see here on the bottom, typical J curve. We are going to invest early stage investors really at the beginning, and we intend to keep this asset a long time to exit later at a huge profit. That's the intention. So historically, we are seeing it's moving up, the J curve. So we've still entered at the beginning. We're not changing our position, and later on at the top, the management has some faith in this company, and they have some news, and they think they could take on some additional exposure. Shortly after, they exit. Partially, more than the last acquisition. So the last acquisition has been completely sold, and so they are not in the stock anymore. So how are we going to evaluate it? Firstly, let's understand what it means using FIFO, LIFO, and WAP. If we are using FIFO, what it basically will mean at the end when we are calculating the profit, we will say, okay, this is long-term investment. We entered early and now it's time to exit. So now we're slowly going to exit our position with using the available shares. We're going to slowly do it. So we are also now going to measure the performance of the board taking this decision to invest into this asset in the first place. So we are going to, since there's a huge difference in the beginning and end, we're going to start taking use profits as well when we are exiting the investment. Now, on the other side, if we are using LIFO, what does this mean? So we added some exposure at the end. So we will take profit, a little bit profit on that to show to our shareholders that it was indeed a good decision to add some additional risk to the portfolio, and that's it's not going to be huge, but we're going to totally take that profit and create it, and then we are starting to get also into that exit position. We're going to see some of the first in approach, the first acquisition, and that's going to show us some more profit, but it's going to be still a long-term investment because we are not going to exit it completely. So this is the first major difference between FIFO and LIFO. LIFO is going to be a long-term investment. Perhaps we're taking some additional risk along the way and exit them slowly, but it was not. It's more speculation at the end than at the beginning. At the beginning, so first in, first out method would be just we are going for it, and at the end we're going to exit. In this case, we'll exit. We took on some additional risk for whatever reason, and we exited. So, and the idea with FIFO would be that we would start exiting completely, let's say in the next year or two. Whereas LIFO, if we were using the mentality of LIFO, it would have mean, yes, we are going to keep it even longer. So we did take some profit, but it was not the main idea behind it. So this is already things you will have already discussed with your accountant, or at least your accountant should have asked you about these things. What is the purpose? And then next, the weighted average cost price. What is this going to measure? Well, actually, this is very basic, rudimentary evaluation. So you're just going to mix a little bit of everything together. And what it does, it doesn't clearly show what you did by adding some additional exposure. It will dampen your results on the last one, but so it's really not ideal if you want to show your board any of what I've previously explained in regarding LIFO and FIFO. So my point is, by all means, if you don't have any better method, use the cost, the average weighted cost for evaluating your exit process. If you have a better method, it might make more sense using that method in the long term. It's a bit more work to do, but it's definitely worth it. Then, final comment, it would, in my opinion, it would be great if we could see these type of differences shown in the management reports at the end of the year to your shareholders. What if, I know this is not obligatory, and I am pretty sure many of the managers are going to try to avoid this, but it would have been great to see this, to see exactly what our measurements would have been, how we are taking decisions in the company. And so, having said that, my name is Christoph van Tonder. I hope this video has been informative, giving you some background information how to evaluate and what each of these valuation methods mean. I haven't gone into technical calculations of each method. If I get enough demand to prepare such a video, I would gladly do that as well. So if you would like it, please don't hesitate to drop me an email. My email address is here as usual at the bottom. Don't forget to like if you like this video, and subscribe to get informed once I've put up some new videos. It's a pleasure speaking to you guys. Looking forward to hear your comments. See you soon.